Well, it's been a while since we've done a full portfolio overview, and we're going to be doing one today. Spoiler alert, it looks ugly. We're down $43,500. The past year has been incredibly tough for these type of companies. Anybody that's a tech investor knows this. Now, we're going to be looking at my top holdings. We have Amazon here that's continuing to just do terribly. It's in a 5% free fall today. Then we have Netflix that's having a bit of a bounce back. This is my second largest holding. Then we have a lot of other tech companies, Microsoft, Google, Adobe, Salesforce, Apple, and then we got BRK and CROX, a smaller position here as well. Now in this video, we're going to be going over all of them. I'll be giving an update on my thoughts, what I'm doing right now with my portfolio so heavily in the red, and how I view this experience overall. I'll be giving my thoughts going forward from this perspective. So we have a lot to jump into in this episode, a lot of news to cover. Before jumping specifically into my portfolio, I want to jump into some macro news here. We have news that the Fed is meeting tomorrow. This is the big meeting where Jerome Powell gets up in front of the podium and he says in a very serious voice how they're taking into account all the situation, the rising interest rates, they're determined to crush inflation. It's the top of their objective, right? That's everything that's going to happen tomorrow. Now, if we dig down into what actually is going to change, we're going to see another 75 basis point increase tomorrow. So the number's likely going to be 0.75 percentage points increase. That's what's expected right now, which will put the federal funds rate at 3.75% to 4% at the end of this year. Why is this important, and why do I bring this up in contrast of this portfolio? Everything the Fed is doing by raising interest rates has a downward effect on these companies. Warren Buffett says that the federal funds rate is like gravity. It forces everything else down because the risk-free rate goes up. So as the federal funds rate goes up, a lot of these companies' prices continue to trade down. So even though we look at the fundamentals and we look at the businesses and their future outlook, we have to pay attention to the federal funds rate. It's a huge factor in at least the short-term performance of our companies. Stock prices trade around every single day, and we've seen the volatility with these companies. But one thing's for certain, as long as the Fed continues to raise interest rates like they have this aggressively, stock prices, especially for growth companies, are likely going to continue to come down. It's something we just have to take into account. If I look at my portfolio here, now I'll skip over to the story fund. This is my growth tech portfolio. We're currently down $43,500. And again, I started this portfolio and really started putting money in. You can see the deposits here, January, February, March of 2021, which in hindsight, if you're operating in hindsight, that was a bad time to be putting money in the market. But again, it's easy to say in hindsight. Now, why do I show this big loss? Why do I put this out publicly? I think a couple reasons. One is that I think it's important to have a level of transparency. One of the foundational things that I started both my YouTube channels with is that I thought that the entire financial industry was incredibly opaque. People would tell you what to do with your finances and never show you what they're doing with theirs. So I think part of the reason that I show this is because I wanted to try to promote change in the financial industry, having actual transparency with what you're doing with your money. But that's also not the only reason. I think it's also good for everyone to realize that if you're down over the past year and a half, you're not alone. You're not the only one that's been beaten up over this bear market. Most people, in fact, the huge majority of people are in this situation. And a lot of the people that say that they aren't, that they're doing great, that they were hedged and they were short, that aren't transparent, I think are being dishonest. Frankly speaking, I think a lot of them are full of it. So when I look at this performance, I'm fine showing this, and I'll continue to show it for the next 5 years. Now, when we compare the story fund against the S&P 500, that's what this chart does here. The story fund is the blue line. The S&P 500 is a red line. You can see the divergence started here late last year when the sell-off started. The companies that have held up really good during the sell-off are consumer staple, dividend-paying companies, the very boring, projectable companies. The ones that have done worse are anything related in tech, anything with a little bit less current cash flows. Those ones have not done well. So I'm not trying to make excuses, by the way. I'm just trying to give some context here. The story fund is underperforming SPY currently. We're down minus 21%. And the S&P 500 is at 2%. So we're getting crushed right now. Anytime I feel like we're making some progress, like we went up the last week to minus 16%, then we had Amazon report earnings and the stock dropped, knocking us back down. So this has been a struggle. Anytime I feel like we're making some progress, we have something go wrong in the portfolio, knocking us back down. But in my opinion, again, when I look at this, I think most of the problems with the story fund and these holdings I think a lot of them are macro related and a lot of them are very temporary issues. I'm looking at this over a 5-year time horizon. So my goal is to outperform the S&P 500 from now till the end of 2025. That's the time that I've given myself. And I'm looking at that through this long-term perspective. Now, if we switch over to the current holdings page, I think we can see this clear. I have 9 positions right now. I'm currently down $37,600, which is 28% decline. So we're down 28%, and most of this unrealized loss is concentrated into 2 current positions, which is Amazon and Netflix. I'm down 34.8% on Amazon, 37% on Netflix. So both of these companies are my 2 big losers, and they're ones that I want to talk about. Now let's go ahead and jump into Amazon here. If we look at the latest numbers, it's amazing that Amazon, for the 5-year performance, has traded all the way back down to where it was in 2018. Amazon was selling for $100 in 2018. So investors that bought right here are basically flat over the past 4.5 years. They're almost entirely flat on the holding, and that's troubling. You look at that and that's disappointing. We look at what's happened since 2018. I can put this annual here to make it clear. We look at it, and in 2018, there was $232 billion in revenue. So they revenued 232. 2021, it revenued 469. In 2022, they're going to beat $500 billion in revenue. So revenue has gone up almost double from 2018. The company's growth has literally doubled, but the stock price is the exact same. That's problem number 1. Why is that happening? Well, Amazon does this pesky thing where they throw all of their cash flows into different growth investments, which makes their profitability and their free cash flow metrics look awful. Now, we see this happened over the past couple of years, and especially in 2021 to 2022. If we look at the chart of the free cash flow annually, we can see in 2018 to 2020, Amazon was growing their free cash flow lockstep. They're growing it every single year. In these 3 years alone, they generated $64 billion in free cash flow. $64 billion in 3 years. That's pretty good. And the amount of free cash flow is going up incrementally, like you can see, every year. Then what happens after that? 2021, the free cash flow goes to minus $15 billion. If we look at it quarterly, it gets even worse. The growing amounts of free cash flow for Amazon over time, the narrative changed in 2021 when they decided to do this big investment cycle. So here we see the continual negative free cash flow quarter over quarter. In just the past couple of years, Amazon's done a lot. They've doubled the size of their fulfillment network. People are getting their packages even quicker. They're taking more market share online. They're increasing pay. They increased their stock-based compensation a lot. They're trying to steal talent from Meta and Google, which they are doing successfully. And all of this is expensive. So right now, the free cash flow is swung into the negative, and Amazon has again done all of this, lowered their profitability, increased their reinvestments at a time where this guy is wanting to increase interest rates. That is the problem here. I think the culmination of these 2 things happening at the same time is kind of like a perfect storm for Amazon. It's the worst case scenario. We have macro factors working against them as they're doing a major investment cycle. Investors in Amazon want to see profitability right now, and they're not showing that. What else is Amazon doing right now? They're giving away more value to customers. Sounds familiar, right? Amazon expands its music catalog and podcasts ad-free for Prime members. And the level of expansion here is absurd. Starting Tuesday, Prime members who have so far been able to listen to about 2 million songs for free, 2 million, is now being expanded to 100 million songs for free. No ads. This is the same as the free version of Spotify, by the way, but with no ads. So Amazon is now coming for Spotify and Apple Music. In fact, it's expected that in 2023, Amazon's music service will surpass Apple Music in subscribers. They think that Amazon will become the second biggest. And that's what Amazon is up to right now, giving away more free stuff, more free music, hundreds of millions of songs. They want to have the best song service and compete on that ground as well. Amazon continues to be the company that wants to just grow and grow and grow and conquer every single category they compete in and not really focus on profits. In fact, all of the cash flows are just redirected into other things at a time where the market is wanting profits, profits, profits. So there's some butting of heads right now. Investors are trying to figure out where they want to put money, and they don't consider Amazon safe. And for those investors that are looking at it through that way, I actually agree with them. I think if you're looking at your invested capital in the short term, I wouldn't consider Amazon really a safe investment either. I think it's very risky in the short term. Trades at a higher PE ratio. They're not going to be showing a lot of profits from this year or the next. But again, I'm looking at this long term. And I know it's cliche. It's a bit of a trope for any investor that's down on a stock to say, since I'm down on the stock, I'm a long-term investor, right? That's something we all do to some extent. If you're down on a stock, you turn into a long-term investor. If it goes up, then you're excited about it. But I want to explain what I really mean by looking at it long-term, because I think there's some different thought processes here. When I look at this as a long-term investor, I really imagine myself as being an owner of the company, as if I was like a big founder of the company and I owned 10% of Amazon. Let's just imagine for a minute that you owned 10% of Amazon. So you have a lot of money. You don't really need the money right now, but you own 10% of this great company. And all the time you're getting offers from other people to buy your stake. They want to own Amazon, so they're giving you offers left and right, saying, I'll buy it for this price, I'll buy it for that price. Back in 2017, the offers were at a valuation of around $600 billion. Then in 2018, it went up to $1 trillion. So now you'd get a clean $100 billion from selling out. But then in 2021, the valuation went up to $1.5 trillion. So you could sell out at $150 billion. But again, if you're a big owner of this company, you own 10%, the way that you'd look at this and selling out of your shares, if you're actually involved in the business and you can see the future of it, is you'd probably judge it based off of what direction you think it's going and how you think things will play out over the next decade. If I own 10% of Amazon and I had offers to buy out my stake at $1 trillion, I'd simply just look at the business and imagine where it would be in a decade and if I think it will be worth a lot more over that time period. And right now, I still see Amazon growing. I see it becoming more valuable over time. And these short-term fluctuations of it going up 50% or down 50%, I consider those short-term market trading, driven by macroeconomic factors like the Fed and the interest rates and different things like that. When I look at the actual business that I'd be selling right now, selling completely out of and giving to someone else, I look at this growth. Amazon online sales, their first party grew by 13% on a constant currency basis. Their physical stores grew by 10%. This is just last quarter. Their third party sales, this is the high margin stuff, grew by 23%. Their subscription services grew by 14%. Their advertising services grew by 30%. 30% growth. AWS grew by 28%. And then the other stuff that they're even playing around with grew by 168%. Every part of this business is growing. It's growing actually quite quickly. Contrary to what other people say, it's growing above 10%. So as a 10% owner of Amazon, assuming I have this large stake, I get these offers for $1 trillion valuation, 1.3, 600 billion, 1.5. I'm getting all these different offers. I don't think that I'd sell yet. I think I'd just hang on to the company because the growth that I see and the dominance I see of this company. And in 10 years, I think it will be much more profitable. I could see Amazon becoming worth $3, $4, $5 trillion. I don't think that's out of the realm of possibility. So right now, looking at Amazon, I know all of this volatility is tough. Amazon is a very volatile company. It's had a really bad year. I think it could even drop a lot further, but it doesn't change my long-term perspective. I still see Amazon Prime subscription as being something that most households are going to keep. They really like it. I see AWS is growing mid-teens to high 20s throughout the next decade. I see the third-party seller business flourishing. I think the company's in a good situation. So right now I'm hanging on to it. And again, I think it will be much bigger in 10 years. Now, moving on from Amazon, I want to jump into my next largest position, which is Netflix. This one is also a very large position with a $20,000 value. And I'm currently down $11,900. So I'm down 37% on this company. It's been a bit of a doozy. Again, this has been a very volatile year and a volatile holding. The reason that I hold this company, and I want to explain why I continue to believe in Netflix, even though it's gone through this dramatic fall, the story for me hasn't really changed. The reason that I invested in the company hasn't really changed. So we look at these charts here. We see the company's down big. A lot of investors have soured on this company. Price drives sentiment. So as the price goes down, sentiment turns more negative. But again, I'm invested in the long term, and the reasons that I invested in Netflix have not changed. What I've seen happen when I study history is I see that over the past 100 years, there's been a type of entertainment that has reigned supreme. It's been a great form of entertainment, economically speaking. That is cable television. The cable providers had people paying them $120 per month to be entertained. And you have all these channels combined, and then they advertise on top of that. Consumers were paying a lot of money for valuable entertainment. And the cable companies had great economics. They were great companies for 100 years. Now a transition's taking place. Over the past 10 years, there's been what's called cord cutting. You probably heard about it online. You're probably part of it yourselves. Meaning that you're moving from cable TV. You're no longer subscribing to these big yearly contracts and paying $100 plus a month, but instead you're subscribing to Paramount Plus and Peacock and Netflix and Disney Plus and HBO Max, right? You have all those subscriptions. That's the transition that's taking place. When this transition takes place, and it will continue to take place over the next 20 years, there's going to be companies that come out on top of this transition, that survive it. And other companies that can't make scale, they can't get big enough, their economics don't work out, many of them will fail and they'll be sold to different streaming services. So we're going to see some consolidation. But as I see this transition take place over the next 20 years, I continue to believe that Netflix is going to be not only one of the survivors, but one of the biggest participants in the new form of entertainment, which instead of linear cable television, it's direct on-demand entertainment delivered through the internet. So I think Netflix is positioned already at scale with 220 million subscribers, already with an international presence to take advantage of this overall change. And then even going beyond predicting the winner, there's also the discussion of what the economics will look like for the winners of this transition. A lot of investors believe that even if Netflix does win the streaming wars, the prize for winning the streaming wars is not that great. They don't think the economics of streaming is all that great. I disagree with that. So I have two major assumptions here with Netflix. Assumption number one, this transition from cable TV to on-demand entertainment is happening. It's going to continue to happen over the next 20 years, and Netflix is going to be a winner. They're going to survive the transition. They're going to be a global, highly scaled, streaming on-demand entertainment company. Assumption number two that I'm making for Netflix that I think is up for more debate is the economics of streaming in general will eventually be really good, especially for the biggest scaled leaders. I think that the economics of Netflix are going to look good over the coming years. When I look at this on an annual basis, we have Netflix having major cash outflows, right? They throw out a lot of cash for their content, and then when their content's released, they amortize it. So that's how they do their content schedule. And you can see these major cash investments they're making because Netflix has the calculation that these are good investments to get ahead of all the other streaming services. So they're throwing out a lot of cash, and now we see the economic swing in the other direction just by slowing down their spend on content a little bit. They posted $2 billion in free cash flow. By the end of this year, in 2022, we can zoom in quarterly here, Netflix is actually going to post positive free cash flow for the entire year. And it's likely going to be around $1 billion. And then in 2023, I think Netflix will post between $2 to $3 billion in free cash flow. I think the amount of free cash flows will double from 2022 to 2023. In fact, it might over double. So I see Netflix as a company that now has gotten to the point where their investments can start to make returns. They made all of these investments for the past decade. Now they're starting to see the return on it because they've reached scale. And they're moderating their content spend to $17 billion. They're growing their ad tier service. They're doing other investments like buying gaming companies. That doesn't play as big of a role in my assessment. I think the ad tier will be another thing that's accretive to the bottom line. I think it will add more revenue to the company with very little expense. So when I look at this company, Netflix, it's the same type of thing. We can argue about the volatility and when's the exact best time to jump into the company. But what I'm doing is buying into companies that I think in 10 years will be scaled, highly profitable leaders where there's a lot of debate right now. Netflix, there's a ton of debate right now. The future's unclear. I'm making a prediction here and I'm putting my money behind it. And I continue to buy into this company if it goes through any substantial drops. So I've been buying more into it over the past 6 months, and that's been good for the returns. It's actually made up for a lot of the losses. So that's my thoughts on Netflix. There's a lot of volatility, but the story for me remains the same. Now, after Amazon and Netflix, the positions get substantially smaller from here. So there's a large concentration of the portfolio in these two companies. Moving on beyond that, we have Microsoft here. I have around $12,000 invested in this company. It's down around 14%, so not so bad. Microsoft, I've given my opinion on so many times. This company for me, in my opinion, I think is an easy buy. It trades at a mid-20s PE ratio. It could very well trade lower. In fact, in this market, I'd predict it will. But over the long term, with all of their various businesses, they're heavily diversified and they're a subscription-first company. Everything Microsoft does, they try to wrap it in a subscription, and they're very successful at that. That makes their revenue incredibly predictable. And the company will continue to grow with their incremental price increases. So you can argue about the valuation, but I think the direction Microsoft is going in is very predictable. Overall, I think this company is still in great shape. All the fundamentals look like it's going in the right direction. Google's the next one. I have $12,000 invested in this company. I'm down 23%, so $3,700. I have a note here from Qualtrim saying that these companies are trading down in part because of the future impact of the Fed policy. Investors are very nervous right now waiting that Fed meeting. So we have Alphabet here trading at a 16 forward PE ratio. My opinion, this is a little cheap for this company, but it has some major headwinds. The ad market going into a recession is a short-term headwind. If you look past that, if you really want to own this company for the next 10 years, it has a lot of long-term secular growth and tailwinds that I think will make this price look cheap in hindsight. But if you're looking at it in a 3-month perspective or now until the end of the year, I think Google does have some short-term headwinds. So this one I'd be a little bit more careful about in the short term. After that, we have some software companies, Adobe and Salesforce. Both of these companies are down big, and Adobe's trading at a 21 forward PE ratio. The company is a growth monster. That's the story of Adobe. Their free cash flow. We're not looking at revenue here. We're looking at free cash flow. The growth is incredible. And I think even though they paid a high price for it, I think the Figma deal is going to benefit Adobe. So I'm excited as a long-term shareholder. In the short term, again, I don't see this company really going up at all until the federal funds rate levels out a bit, until they stop raising it so aggressively. At that point, I think Adobe could start to move up. But right now, we're again in a big downward trend. All of these world-class tech companies trading way down from their highs as the federal funds rate moves up. Salesforce is a company that I refer to as mini Microsoft. It reminds me of Microsoft's core suite of software, their Excel and Word and all of that. Salesforce has an operating system for businesses for customer service and sales management, and it gets integrated into the company. It's very sticky. They do have I think a lot of pricing power. I think it's difficult for corporations to remove Salesforce out of their company. And again, this company, Salesforce, like every tech company, has just been beat up over the past year, down 46%. So as it trades down, I look at it and I look at the overall fundamentals, and it's hard to argue that things are moving in the wrong direction. Basically, every metric, especially the most important ones, they're growing. The amount of free cash flow is growing. Even the free cash flow per share, with their share issuance, investors are still getting more free cash flow on a per share basis. So I like the direction this company's going. I'll continue to hold it as long as the fundamentals are moving in this direction. Now, after all of these software companies, we get into the ones that I'm actually in the green on. Apple's one of the rare companies that I'm currently in the green. $4,300 in value, I'm up $600. So it's a small holding, and Apple's just held up a lot better than most companies. I know a lot of investors get frustrated with Apple because they think the company should come down in price. I totally disagree with them. I think 25 forward PE is actually not expensive considering how good of a company this is. One little piece of information here, just one piece of information. Apple has currently around 900 million subscriptions sold. So between Apple Fitness Plus, Apple Music, Apple TV Plus, yada, 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 all their different subscriptions, they have around 900 million. So we can do some simple math here, some simple hypothetical assumptions. Let's say that out of these 900 million subscriptions, Apple raises the price by just $1. $1 per month per subscription. That's an additional $10.8 billion in revenue for Apple. $10.8 billion for just $1 per month. And that's high gross margin revenue. You have to believe that about 80% of that is pure profit because subscriptions don't cost a lot when you raise the price. It's basically pure profit. Now, if Apple raised the price by $2 per month, which they're doing for a lot of their subscriptions, you can assume that's $21.8 billion in additional revenue just by a $2 price increase. So Apple has ways to grow their revenue, to grow their high margin revenue, their subscription revenue with very little ease, just by these minor price changes. They can grow an additional $20 billion, 10 to 20 billion, depending on how much they raise prices, per year in high margin income. That'll not only grow their top line, but it will more importantly grow their bottom line. I can see a lot of that additional 10 to 20 billion hitting the free cash flow line item next year. And I see this as an additional lever that Apple has to pull. So while a lot of people look at Apple and see that this company's grown a lot and it's really big and they don't think it will continue to give good returns, I see the opposite here. I see a company that's grown really big, but I think it's going to grow bigger. I think it's a company that has given good returns, and I think it will continue to give good returns. And I have reason to believe that. I think the company, again, just has so many things it's working with. So with Apple, I think the story has remained the exact same. The product line is great. They're growing that over time, but the subscriptions is going to be where incremental additional free cash flow come from. Moving on, we have Berkshire Hathaway and CROX. These are two very small holdings in this portfolio. This is a way to get exposure to Apple, I think, with less risk. So you have a lot of Apple in your holding of Berkshire Hathaway, but you also have an entire insurance business, a huge energy business, and a lot of exposure to different things. So it's a bit like an ETF ran by, I think, very smart investors. So I don't have any specific thesis on this one. I think they'll keep leveraging their opportunities to reinvest at such attractive rates, and they'll continually beat the market. I really think that Berkshire will beat the market over the next 10 years. Now, CROX is the only company in my portfolio that I don't consider a super long holding. This one's more of a short-term thing. I plan on holding it for maybe a year or two. I want to see how it trades. Right now, I just think it's so cheap. So CROX is one that I'm buying a lower quality holding for a cheaper price. We'll see how it works out, but right now it's a very small holding. I would not make CROX a very large position. I'm keeping this one below $2,000. But that is it right there. That's all 9 holdings in the Story Fund and my current thoughts on them. Hope you enjoyed this video. I'll continue to be transparent with the portfolio and show updates even if it gets worse. This year could get worse, especially if Jerome Powell continues to bump up interest rates. So we'll see what happens. I'm going to have another video out similar to this one, but on the Story Fund watch list. Companies that I have on the sidelines that I could swap in if one of mine is not performing the way I want it to. So I'll have that video out soon, and I'll see you there.